I think it's also interesting, Scott, to take a look at what's going on in the bond market. You know, we've had this spike in interest rates, which we've taught you before on this show, that a spike in interest rates causes a downturn in the value of a bond. But that is really only a temporary dislocation. And LPL Research, our partners that we really do rely on for the equities markets and the debt markets and things of that nature, they actually put out a statement, and I'm going to read the conclusion. I'm not going to cut through all of there was about 3 or 4 pages of gobbledygook. But
so I can go ahead and leave.
No,
go through all that.
No, not at all.
Take a bathroom break.
Here's what this says. It says core bonds have been a staple in diversified asset allocations. Absolutely. We do that here at Gen Wealth. If you are invested with Gen Wealth, then you're likely to be highly diversified in an asset allocation portfolio. However, with returns as negative as they have been this year for bonds, and they have been, investors may be undergoing a rethink of the utility of core bonds. We think that may be a mistake. Now, that is about as definitive as you're going to hear a research person come out and say something.
Yeah.
We think it may be a mistake. We still think the value proposition for core bonds remains. Liquidity, equity diversification, and total returns are all valuable properties of core bonds that they bring to diversified portfolios. And each of those value propositions have improved recently. Mm-hmm. So where someone may be looking at their short-term bucket money, Ginger, as you were talking about earlier, maybe it's down a little bit and they're going, well, now wait a minute, I'm not supposed to be losing money. Just wait. Everything's good. And by the way, we also have cash sitting here to feed your income while we're waiting on those bonds to recover.
That's right. You know, we always make sure that you have plenty of cash. When, in fact, we try to have at least a year's worth of cash just sitting there so that you're not dependent on the market in any way. You know, whether it's in your conservative money or your growth money, we don't want you to have to sell anything while it's down. And that's the whole point of us having enough in cash that you've got your guaranteed income sources plus whatever else you need to supplement those for your desired amount of income.
It's been the worst start, one of the worst starts ever for a 60-40 portfolio in 2022. But to John's point, the bonds have taken the hit now because of the negative price impact that rising interest rates have had and rising bond yields. But the concept here is are those yields going to start to stabilize or at least tick up slower and not be such a shock to the price side that the total return is actually better? So yes, bonds still have a place in your portfolio, and yes, equities still have a place in your portfolio. And now is not the time to bail on either of them, but it is time to plan. Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.